the signal hidden inside normal behavior. Nothing unusual appeared at first. No spikes, no breakdowns, no obvious warning. The market looked normal, and that was exactly where the signal was hiding. To understand why this matters today, we need to confront a dangerous assumption. That risk announces itself through extremes, through volatility, through visible stress. In reality, some of the most important signals emerge when everything looks ordinary. For a long time, behavior felt familiar. Prices moved within expected ranges. Reactions followed routine patterns. Participants did what they had always done. Normality became confirmation that nothing had changed. But normal behavior can mask abnormal conditions. The first reveal begins with repetition. The same actions produce slightly different results. Trades that once resolved cleanly now took longer. Recoveries arrived, but they felt thinner. Nothing failed, but nothing fully reset either. Normal behavior was no longer restoring balance. The second reveal appeared in consistency. Participants continued executing familiar strategies, but outcomes varied more than expected. Effort increased. Results diminished. The system still responded, but it required more input for less effect. That imbalance wasn't noise. It was information. The third reveal emerged when experienced participants sensed discomfort without evidence. The market felt heavier. Liquidity was present, but reluctant. Support appeared, but it didn't inspire confidence. Everything looked normal, yet nothing felt effortless anymore. That was a signal, not a breakdown, not a shock, but friction inside routine behavior. Markets don't change character overnight. They change when familiar actions stop producing familiar outcomes. When normal behavior begins carrying hidden costs, the system is already adjusting. Even if no one has named it yet, the market hadn't failed. It had started resisting itself. And when resistance shows up inside normality, it's often the earliest warning that structure is shifting beneath the surface. What followed would reveal how dangerous it could be to ignore subtle signals embedded in routine behavior, and why markets often warn us long before they ever surprise us. As normal behavior continued, the hidden signal grew stronger, not louder, but more persistent. The market kept doing what it always did, yet each cycle felt slightly less effective. Adjustments worked, but only partially. Balance returned, but briefly. Something subtle was changing inside the machinery. The conflict emerged in efficiency. Actions that once stabilized the system now required repetition. One response was no longer enough. Support had to be rebuilt again and again. Liquidity appeared, withdrew, then reappeared. Normal behavior was still present, but it was working harder for smaller results. Liquidity revealed the shift most clearly. Depth looked familiar, but it didn't feel reliable. Bids showed up, but they faded faster. Capital participated, but with caution. The market wasn't lacking resources. It was lacking confidence in outcome. The tension deepened as this pattern repeated. Each familiar move trained participants to expect less impact. Effort increased. Patience shortened. The system still functioned, but it no longer reset cleanly. Normal behavior had become maintenance rather than resolution. Institutional desks noticed a change through execution. Trades took longer. Slippage increased subtly. Timing became less forgiving. Strategies designed for routine environments began underperforming. Not because they were wrong, but because the environment was no longer routine. Derivatives markets echoed the same message quietly. Protection stayed bid even during calm sessions. Volatility pricing resisted compression. Traders weren't hedging catastrophe. They were hedging inefficiency, the risk that normal behavior would no longer do its job. The build-up continued as participants adjusted unconsciously. Position sizes shrank. Exposure became tactical. Optionality replaced commitment. These shifts weren't reactions to headlines. They were responses to friction felt inside everyday market behavior. Veteran participants recognized the warning clearly. When normal actions stop restoring balance efficiently, the system is telling you something. Structure is changing. Resilience is thinning. The market is compensating for weakness it hasn't yet revealed. The market was still normal, but normal was no longer neutral. And the next phase would reveal what happens when a system continues operating on routine, even as routine loses its effectiveness, when a hidden signal finally demands acknowledgement. Because markets don't whisper warnings in extremes. They whisper them in repetition. The moment that exposed the signal arrived without drama. A routine situation unfolded, the kind the market had handled countless times before. Familiar patterns appeared. Expected responses followed, and they didn't work. Prices adjusted, but balance didn't return. Support formed, but it didn't hold with authority. Recovery attempts stalled earlier than expected. The market behaved normally, yet the outcome felt wrong. The hidden signal had moved from background friction to visible failure. The conflict intensified as repetition met resistance. Participants tried the same responses again, expecting delayed success. Instead, effort produced diminishing returns. Each attempt to restore equilibrium required more capital, more patience, more coordination. Normal behavior was no longer enough. Liquidity exposed the truth clearly. Depth appeared, but it thinned under pressure. Capital stepped in cautiously, then stepped back. The market wasn't refusing to respond. It was struggling to do so efficiently. The signal hidden inside routine behavior was now shaping price. Institutional systems reacted automatically. Algorithms increased activity. Risk controls adjusted thresholds. Committees revisited assumptions. But every response was designed for an environment that no longer existed. Structure lagged reality. The buildup accelerated as correlations tightened. Assets that once distributed stress began sharing it. Diversification weakened. The system's internal buffers, built for routine conditions, were being asked to handle something they hadn't been calibrated for. Veteran participants recognized the danger immediately. When routine responses fail, it's not volatility that's missing. It's resilience. The market hasn't lost information. It has lost elasticity. And elasticity is what allows systems to absorb pressure without breaking. As sessions passed, familiar reference points lost reliability. Levels that once mattered now delayed movement instead of stopping it. Every action felt heavier. The market wasn't panicking. It was revealing constraint. That was the realization. The signal had been there all along, hidden in repetition, disguised as normality. What looked like stability was actually strain being redistributed quietly through routine behavior. The final phase would reveal what happens when a system finally acknowledges that normal is no longer neutral, and why ignoring that signal always makes the eventual adjustment more severe. Because when routine stops working, the system is already past the warning stage. It's entering the consequence stage. Acknowledgement arrived quietly, but it changed everything. Once participants accepted that normal behavior was no longer restoring balance, the market stopped pretending routine was enough. Adjustment followed, not explosively, but decisively. That was the climax. Not a breakdown, but a recognition. The system finally admitted that familiar actions no longer carried the same stabilizing power. Price moved until repetition stopped failing. The hidden signal that had lived inside normality forced itself into the open. Liquidity returned with conditions. Capital stepped in selectively, but with clearer intent. Support formed lower and held with more authority. Not because the market was stronger, but because behavior had adapted to reality instead of habit. What unsettled many was how logical it felt afterward. Of course, routine had stopped working. Of course, friction had been a warning. The market hadn't changed suddenly. It had been asking for adjustment through inefficiency long before it demanded it through movement. As volatility settled, the resolution unfolded through restraint and recalibration. Participants shortened feedback loops. Strategies diversified. Decision-making became more deliberate. Normal behavior was no longer assumed to be harmless. It was evaluated continuously. The deeper lesson lingered beneath every action that followed. Markets don't warn us with chaos first. They warn us with effort. When systems require more energy to achieve the same result, something fundamental is shifting. Ignoring that signal doesn't preserve stability. It delays correction. The signal hidden inside normal behavior was never subtle. It was familiar, and familiarity made it easy to dismiss. Understanding this reframes how calm periods should be interpreted. Normality is not proof of health. Efficiency is. When routine stops restoring balance smoothly, the market is already under strain, whether anyone admits it or not. Because by the time normal behavior fails completely, the warning phase is already over. Sometimes the smallest shift in perspective becomes the beginning of a new future. The